Okay, let's take a look at valuation. What you're looking at here is the S&P 500. Again, these are one day at a time, 5-minute bars. And on the bottom is the valuation formula. Now, we're not getting into the formula itself, but just to suffice it to say that, from my standpoint, theoretically, valuation numbers are much more stable than anything else, and on a historical basis, I find them to be very reliable, and that enables me to run a lot of statistical analysis on those numbers and then watch the price action in relationship to the valuation. And that's what we're always doing here. So that's the valuation number. Now all I do is smooth it out. The yellow and the blue are nothing more than short-term smoothed averages. And I suppose I could even just trade on crossovers, but essentially what I like to do is to take the valuation first, run a standard deviation on it, and get one standard up is this horizontal line, one standard down is this horizontal line, and the green hash is the mean. Now, for those who might not be familiar with standard deviations, we can get into that discussion either on the webinars, or I'll have a separate module on it. It's actually basically theoretically just a simple concept, but just stacking up a whole lot of historical data. How much does it deviate from the mean? That's where most everything we look at on quantitative sides that are reversion to the mean studies. It's not going to go too far away before it reverts to the mean. Well, the mean of what I think is the relevant discussion as to if it's that spins on a roulette wheel, that's not as significant as the valuation of a real asset. So that's again the principle I work on. Now. This is the valuation on the index itself, and mathematically it's the exact same thing as if I had done it on every individual stock within the S&P 500. And to give you an example of that, here is an energy portfolio that a trader out of New York had wanted me to construct. And it's, you may not be able to read it here. I'll just rattle them off on the screen. Exxon, Chevron, Schlumberger, Conoco, Occidental, Apache, Transocean, Devon, Anadarko, XTO, Chesapeake, China Petro, Noble, Suncor, and Petrobras. Now on those, I'm running the valuation on these individual stocks and getting the aggregate number and running the valuation on it. And again, I'm not getting into the particulars of trading off the mean or what happens when I get divergences and so on. We'll get into that. But just generally speaking, good spot to sell it, good spot to buy it, good spot to sell it, and a little bit of a pickup right here. So that's the starting point. Now, what I'm going to do is this is based on 5-minute. I could have refined it down. In fact, I have refined it down to 1 minute, but at some point it gets a little ridiculous. 5-minute, good enough. I am going to give you, and I always call this kind of my high-level overview, like flying at a couple of thousand feet or so, getting a lay of the land. As I had mentioned in the intro, I'm going to take up at even a higher elevation at 60-minute increments, and this takes you all the way back to late December of 2009. Now, I brought this screen up in order to show you how I do look at larger trends and smaller trends, but this is the big picture trends. We're going to take a look at what happened on the sell-off here, this retracement after we had this fairly significant rally off the bottom of that tragic situation we had in 07, 08, and in the early part of 09. I wanted to focus on something here. And again, this is just a couple of parallels here, and all I did was bracket them up. Nothing real complicated. In order to get to the discussion of the target pricing and the internal strength and how that coordinates, we're going to try to cram all that in this session, and in the next one, we run a little bit over as we get close to a 10-minute mark. I'm going to use this as an example right here. We had this little punch down, it came along, went up next channel, got up there, comes back down, and then rallies up, and boom, takes a punch here on the 25th of February. Well, let's isolate this. Let's take a look at it. I'm going to go back to the 5-minute valuation. And we were already, we had some divergence here. We're at an upper standard. Prices kept on just modestly pushing, and we started coming down on the valuation, and bam, comes down, had a pickup, starts to get to the mean, and then it does it a second time, slams down. Now, this actually, shouldn't have happened, but it did. It's not a science. This is a social science. And so the market comes down. Let's take a look at how we were able to pick this up off the bottom, looking at the target and then also the internal strength. So let's take a look at the cash targets. There's the 25th right there. Now, overnight starts failing. You get stopped out on your long play, and then all of a sudden, overnight it's coming down, and by the time you get to the open, it is beyond. Now, this is rare to actually open up beyond the low target. These are, I'm telling you, for years, very reliable. And so when it gets to this level, you're saying to yourself, this is something's wrong, and this could be a disaster. But a couple of things. Number one, I take a large sampling population, statistical population of all these instances when I get to my extremes. And I measure and run standard deviations on how far does it run, number one, regardless of any other study, how far does it run beyond the extreme? And this red line right here was the extreme. If I click on this, that was cash 1091 spot 94. Now, and I'll discuss it probably during the webinars if somebody is curious about historically some of these extremes and how far it goes. In this case, recently in the past say 3/4 of a year, I'll get it in 5-point increments. So in this case, this hash line is 5 points below the low target, and if my internal strength, which we're going to get to here, probably in the next video, shows me that the strength is worsening, I can add another 5 points below that. It hit right there, just punched this 5 points below, rallied and came back down to it. Now we're going to take a look at the internal strength, because this was marked immediately, and now it was a matter of measuring: is it going another 5, or are we going to hold here? And I think what we will do is I'm going to take you over to the strength screen, and on the February 25th, here we are. And I want to spend some time on the screen, and I think what we will do is we'll just stop this and go to the next video. And what I will do is I'll tell you this, and then we'll come back to it, is that you're looking at the same study on the top half of the screen and the bottom half of the screen. And what you're looking at is a calculation that's running live the market on Alcoa through Exxon, all the Dow 30. Now, I pick on the Dow 30 as a proxy for the S&P. And I'm always calculating the ratio between the two, that's what enables me to convert to the S&P. I could run it on all 500, but quite frankly, and we will be able to probably do that once I have the standalone product, much more powerful. But I'm operating this on TradeStation, which is a kind of a less than robust back-end system. It gets bogged down a bit, so we don't want to cram too many stocks in it. But if you take the S&P, the total capitalization of the Dow, each stock price times share, add them up, the total capitalization of the Dow has historically been no less than 30%, and I've seen it as high as almost 60% of the entire S&P 500. So the S&P is this dragon which has a huge head called the Dow, with a big, long, skinny tail of the other 470 companies. So what we're going to do right now is we're going to cut this, and then we'll pick it up on the next video.